we have, of course, followed several other speakers, including Paul McCulley, who I think most of our viewers know as the former chief economist at PIMCO and a number of other important jobs. And he was talking earlier about the American dream of chicken in every pot. And he said that one thing that everybody agrees, including at the Fed, is that we all would like to have a bigger chicken. And I just want to make sure that he's speaking for the Fed.
Absolutely. We would want to have a bigger chicken or a bigger vegetable, whatever it is you eat. It's really about prosperity. There is no part of our democracy that really doesn't want more prosperity, and the Fed is included in that. And our job is challenging, but important and good, which is we want to support prosperity, support the labor market, and do so without having price stability be challenged. And that's the role of the Fed. And if we do our job well and then stay in the background, all other things are possible from the businesses and consumers' households in our economy.
Everybody asked me, what are you going to ask Mary? And I said, well, I'll wake up on Thursday morning and I'll look at the president's social media feed, and that will tell me what the story of the day is. And of course, he can't lay off. So I have to ask you, how is all that affecting you as a policymaker and your colleagues?
Our work is really important. On the front lobby of the San Francisco Fed head office, we put a sign up. I put it up the very first day I became president. It says, our work serves every American and countless global citizens, but that every American is really important. And that's the work. Congress gave us, as Paul said, Congress gave us our responsibilities, and our responsibilities are price stability and full employment. We work to carry those out every time. Our teams, the committee, the FOMC, we are laser focused on doing those responsibilities. And if you look at the headline numbers on inflation, we still have some work to do, but we are in a good place and we need to finish the job. So that's where we are. And other things, there have been periods of political pressure before, and history serves us best as a guide there. When you stick to your work, the work that Congress gave us, the work that is for the American people, then everything else falls into place.
The president has obviously been sort of direct in his criticism of Chairman Powell. Treasury Secretary Scott Bessent said on Bloomberg Television this week that the president is just working the refs, trying to create a favorable view of what should be done. Does that make any impression on you? Does it work to work the refs?
For me, what is really important is looking at the incoming information, how close we are. I think one of the polls said, we're really close. We have an economy that's working. We have solid growth. We have a solid labor market. The consumers are spending, but they're, making their way in their families. Ultimately, what is still bothersome is we haven't achieved price stability. And I define price stability this way. I do think it's sort of an ethos part. It's when people don't have to worry about inflation. When I go out and ask people across the 12th district, across the country, what's your top worry? And they stop saying inflation, well, then that's going to be a victory because they suffered for too long. And remember, inflation's like the largest tax people pay. It's an unpredictable tax. You're on a treadmill. You earn well. You invest in your business, and inflation erodes your well-being. So I think ultimately that's what we have to think about, and that's really enough to think about, frankly. And that's where my focus is. So other things are not distracting us from our core missions, and our core missions, as we all know, have come from Congress.
So essentially, you're saying we are going to remain focused on inflation. We're not going to consider cutting rates until we are sure inflation's
I did not say that.
Okay. I'm putting words in her mouth to make it easier for the headline writers.
I know that, and so that's why I said I did not say that, so that they understand the next part of that. No, seriously, I think right now when I look at the economy and policy, I see them as both in a good place. But when I look out, we really have interest rates for a significant number of years now in restrictive territory. And what we have is an underlying economy that is responding to those higher interest rates. You have growth slowing. The frothy labor market that was pervasive after the pandemic has now moved to a more sustainable place. People are getting jobs, but firms are finding it easier to find workers and, importantly, keep workers so that they're not constantly on that revolving door of train a worker, the worker leaves. So I think those are all good positions. Then we have inflation coming down. And if we extract or move away from just the goods price inflations, which do show, those numbers have been showing and certainly showed in this week's print, the effect of tariffs, some of those being passed through. But if you look at the other areas of inflation, you just don't see that inflation is pushing back up. You see it gradually going down. And housing services inflation, which has long been, elevated, has been coming down over this year. Services inflation without housing has been coming down, slowly, but coming down. So I see these as the result of the policy that we have in place. But at some point, if you hold the economy too tight, the reins, we're in horse country, if you hold the bridle too tight, you actually end up stopping. And if you stop, then you take the problem people did have, which was inflation, and turn it into a problem that they don't have, which is the labor market. So that's why I see these two goals, the dual mandate, is so critical, because it gives you the kind of balance that ensures people have both things they need: opportunities in the labor market and price stability, so that when they work and they invest, they can build careers and families and communities.
So let me ask you how you're thinking about the economy and what you should do right now, in the sense that this was a big data week. We had consumer prices and producer prices both come in at the headline level lower than anticipated, slowing in economy, especially service prices. But we see some underlying pressures in sectors that are affected by tariffs. Retail sales today came in stronger than expected, much stronger than expected, except for a couple areas that would be affected by tariffs. So could you explain to this audience, and of course the guy at 1600 Pennsylvania Avenue, if he's listening, how you put all that together and decide when do interest rates come down?
Well, there's always been three scenarios that were possible. So the first scenario was that we'd get the tariff effect and it would spill over into all other sectors. So if the price of a tariffed good goes up, then your person cutting your hair, since we were talking about barbers earlier, raises his or her prices, and suddenly you've got spillover. That would make it more persistent. We haven't seen any evidence that that's occurring. And I think that the house price inflation, the house services inflation, and the services inflation coming down reassures you that we're not getting that persistent component. So then there's two other scenarios. One is that you get the tariff effect, but it's relatively contained and it becomes a one-off. And the second is you just don't see much of the effect, because what happens is that as the tariffs settle into whatever level they're going to be, firms who are importing from other countries say, you take half, I'll take half to the country. Then down the supply chain or the production chain, you're splitting it all the way. And so by the time it hits consumers, it's a more muted impact than what is the announced tariffs. One of the pieces of evidence we have for that is that the effective tariff rate as of last week was calculated around 16%, but tariff revenue is only 8%. So that tells you there's some splitting, there's some leakages, some workarounds. Companies are very innovative. They're figuring out other ways to do things. And, this is a global shock. And so companies across the globe are figuring it out. So when I think of that, I'm really of the mind, well, we might end up with a more muted impact of tariffs than we thought. And then this is something I've said publicly since January, is all administrations come in not with one policy, but with a slate of policies. And Paul Ryan said this morning, and I think it's worth emphasizing, the slate of policies have push and pull effects. So deregulation and tax policy, tax relief, those are growth inducing policies. The tariffs could be, and the immigration policy could be growth impairing policies, but we don't know yet. Right? And we certainly don't know the net effect of those. And so that's why it's important to take in the information and not lower rates preemptively, because we just don't have that certainty. And the economy's in a good place. At the same time, you can't wait forever, because if we wait till inflation gets to 2%, well, then we've lost. We've likely injured the economy in some way that was completely unnecessary. And so I'm of the mind that, the summary of economic projections we put out, which had 2 rate cuts for this year, I think that's a reasonable outlook to have. Of course, we are data dependent. If all of you who are business owners say, no, Mary, the inflation's right around the corner and is going to spill over, well, then that's a different thing. It's one of the reasons Reserve Bank presidents in particular spend so much time in their communities asking questions like I asked Crystal this morning. What are you thinking? What are you seeing? are you raising prices because of this, that? And she can give me that information. And so far, I'm not hearing that that's a pervasive outcome.
Let me dig deeper into that and ask you, I know you're talking to CEOs and companies all across the district all the time. What's the basic attitude? Most of the time I'm told by folks at the Fed that everybody's just sort of sitting on their hands right now.
Not in the West. Maybe it's our Western spirit, but I have the 9 Western states, and I don't see sitting on hands behavior. I see cautious optimism, and there's a cautiousness. People aren't, what I heard originally was, we're going to wait and see, but now that the direction of travel on tariffs seems to be negotiation to lower rates than were announced on Liberation Day, and the tax policy and other things that passed, people are already seeing that they can work in this system. And so, I've been to a lot of places since January, and I've been to Alaska twice, which is at the heart of some of the changes in programs that you see. And what they are is cautiously optimistic. Come to the Intermountain West, cautiously optimistic. California, cautiously optimistic. So, that whether I'm in the coastal part of my district, Alaska, I haven't been to Hawaii, but they're also cautiously optimistic. But the Intermountain West, I think this is you guys are always a little poster children for optimistic, but I think it's really optimistic at this point. And, recognizing costs may rise, other things may happen, but workers are easier to find, opportunities are out there, maybe not taking every risk you would take if everything was certain, but certainly not stalling out and waiting to see. The growth, one of my directors put it as, growth does not come to the meek. So you have to take some risks to do well.
When you do go to Hawaii, let me know. I don't know, come out and cover that.
I go regularly. It is in the district, but I haven't been this year, but I will let you know next time.
All right, another question on what you're hearing from CEOs. The big question about whether we have an inflation impact from tariffs is whether companies are going to pass them along. What are the bosses out there, the people who we should have asked Crystal, what are they telling you about that?
Well, firms live in an equilibrium or an ecosystem like everyone else. And so the impulse, of course, is to pass along any cost increase and protect margins. But there's also a recognition that consumers are exhausted, right? They've been paying higher price levels, and then with rising inflation, and as the economy slows, and you see this in the sentiment surveys for consumers, they're a little more worried about the job market, so they're going to be even pickier. And so you would expect retail spending to slow today. If you average the 2 months, you get something that looks kind of normal. But we see consumer spending over time slowing from where it was, but not falling off a cliff. So I think that's just part of a solid economy, but it does discipline the idea that you'll just simply raise prices and push them completely through. And so what we're hearing is that companies are saying they're trying to negotiate with the import country to take a little bit, the importing firms, take a little bit off, and then they're trying to push it along the supply chains. They'll pass a little bit through, but unlikely to pass the whole thing through. And importantly, in the goods sector, this is especially apparent, because if post-pandemic, there was this massive, really large, significant, you could see it in the data, rotation of consumers to goods purchases over services purchases. And people were buying many more goods than they had bought. But now their coffers are probably full. They have a lot of Pelotons and other things, and so bikes and things of that sort. So it's very easy for consumers to be price sensitive on those items and then turn themselves back to services and buy experiences over goods. And I think the goods providers are aware of that. So whatever the impulse is, the practicality has to meet the consumer.
What is, you use the words a solid economy. What to you is a solid economy, and how far do you think we'll be from that at the end of the year?
If we see what we've been seeing, which is that we're slowed to a sustainable pace, and right now, 2% growth is the estimate of trend if you simply add up productivity growth and the labor force growth. So we could get more out of productivity and get a higher number. We could get more out of productivity, get a higher number. We could absolutely grow a little faster. I wouldn't be surprised about that, but I don't think we need to slow precipitously to produce the last mile on inflation, if you will. I think we can actually do it with this steady growth, expansion, and the labor market that hovers around the current level. I wouldn't want to see more weakness in the labor market. I really wouldn't want to see that, which is why you can't wait forever. Thinking that inflation is just around the corner, so we have to wait till we know. I think clarity in central banking is overrated. We want some clarity, but we can't wait for perfect clarity, because then we'll always be backward looking, and by then it's too late.
You mentioned potential growth, which is the sum of productivity and labor force growth. The president has also got policies on labor force growth, bringing it way down. Have you seen effects on the economy in your district yet from that?
You see pockets of places where firms relied on immigration, legal immigration as well, and people there's just a chilling effect on those markets, and so you hear it, but it's in pockets. I wouldn't say there's a broad-based concern over that at this point. I think there was a lot of concern originally, but it just hasn't materialized that way, and so that's been a help. Now, on the, we talked about labor force growth. It is a fact that we have one of the lowest labor force participation rates in the industrialized world for men largely, but women too, between 25 and 54. So our industrialized competitors all have higher labor force participation rates than we do. So when we talk about labor force growth, I think we have to broaden it beyond the immigration. And if immigration's gone, our hands are tied. Really, what is the remedy for so many men in particular sitting on the sidelines?
Is there a model for what you think happens to the labor market based on the immigration policies the administration has?
Well, we have a way. Immigration is gone. It went way up, and it's come way down. One of the remedies that firms use, frankly, is they increase technology so that they can use the workforce that we have and match it with technology. And you see that, we've all been to hotels and convenience stores and other things where self-checkout and self-check-in and all these things have technology solutions coming. I also think, we have this Emerging Tech Economic Research Network at the San Francisco Fed. We launched it in January 2024, and we do CEO roundtables and other things around this topic, and it has been just astounding how many medium and small-sized businesses are adopting generative AI or AI solutions that aren't generative AI, just plain old machine learning, to augment their talent pool and actually expand their productivity with a smaller workforce that can't grow as fast. So I think there are solutions there, and if you could put that productivity and innovation with some increase in the domestic labor force, then I think that could be a very win-win situation for expanding our growth rate.
When personal computers came along, productivity gains were touted that didn't show up for quite some time. I know you follow the tech world very closely. Silicon Valley is in your district. When are we going to see the productivity gains from AI, and how is that offset by job losses that are going to come when the computers do what some of us do?
So one of the things that are really important to know, so a little known fact, maybe I remember it like it was yesterday, but one of my first jobs, I come in as an economist. I'm a microeconomist, labor economist by training, but Chairman Greenspan, as you remember, was very thoughtful about productivity, and he thought it was there even if we can't measure it in the statistics. The statistics are always the last to find productivity. So he set me out, his team set me out to be the collector of anecdotal information, qualitative information on this, and you could see it everywhere. Companies were testing things, they were trying to bring it to scale, et cetera. So the productivity improvements were there long before they ever aggregated up into the aggregate statistics. So now we're going to talk about the job issues. Well, computerization was a technology that actually replaced workers more quickly than it augmented possibilities. Generative AI has a different component of possibility, and I think it's useful for us to remember this. So generative AI can make people who aren't as skilled in something, newly minted workers, people who are, the best example I can find is physician's assistants. Physician's assistants can now triage people in the frontline medical places, if they allow it, with generative AI assistance. So they say, you sprain your ankle. Well, they have a protocol that gets spit out. Did you break your ankle? How would I know? Would I get the x-ray? I'd put the x-ray into there. So they can do these things, and it makes the physician assistant more productive right away. It doesn't mean we replace doctors, but we have a shortage of doctors. And so it's a way to give care and increase productivity in the medical profession. And it's a long way from being scalable, but I think those are the kinds of experiences where generative AI has the possibility to make us better overall. And then the biggest productivity gains come from things we don't even imagine today, and we certainly don't have. So I am not an evangelist for generative AI, but I'm also not a pessimist. And I think the big fact I keep keeping in my head is that no technology in the history of technologies has ever reduced jobs on net. But it does change who is working and who's not, and what skills are demanded. And so when I speak to younger people, I say that you have an imperative to keep up with the new technology and figure out, if you're a welder, how can generative AI help you? If you're a computer coder and you're worried about your job, then learn the AI so that you can do the next job that's available. And I think that's the way we stay ahead of the job losses.
I want to ask you a preamble question to my next question, but the first part of this is just that the president keeps saying in his tweets, Jay Powell should lower the interest rates today. But it doesn't work that way, does it?
It does not. Well, let me first say what we've already talked about several times today, but the committee is tasked, the FOMC is tasked by Congress with price stability and full employment. We have a diverse set of members. There's 19 of us. We debate and discuss vigorously what we should do for the American people, look at those things. And so there's two components of that are important. All members of the committee are important and influential because they're bringing different places, whether they're Reserve Bank presidents and they have a different view from the context they talk to, whether we're just from different perspectives, we're looking at different, we're looking at the same data and the same models, but we're coming to a different judgment. And of course, we're always trying to look ahead. And the people who are the most, I've been working at the Fed for a while and been a policymaker for a while, and the people who are the most valued to me on the committee are the people who don't agree with me. I've got Randy Quarles here, who is was a colleague of mine at the Federal Reserve, and Randy and I would always talk in a way that I really took away. Randy challenged my thinking. I believe I challenged Randy's thinking, but I will leave that to him to say. I know Randy challenged my thinking. I was a better policymaker because I sat with somebody who was able to challenge that thinking. And that's how the FOMC works. And whether you're the chair and all the committee members are challenging your thinking, or you're a committee member and the chair is challenging your thinking, the collective is we share equal responsibility when we take that vote and we walk out of there. Ultimately, we're all answerable to the American people. That's how it works.
And now to my question, most of your colleagues have suggested that July 30th meeting is too soon. There's not enough information yet, although we got this important set of data this week. Two members of the committee have already said that they could see cutting rates in July. What's your position on the next meeting?
So I'm going to tell you how I really think of this, and then I will give you a vague version of an answer to that question. But let me just say, this is how we go back and forth all the time. He wants a date, I say no. But seriously, I think we're asking the wrong question. I don't think the question is it going to be July or September? I think the question is, what's the direction of travel? And there, when you look out, the direction of travel, and you saw this in the summary of economic projections, is rates will be reduced consistent with the fact that inflation's coming down, and we don't want to unnecessarily tighten the economy in a way that hurts the labor market or growth. So that's the direction of travel. Whether it happens in July or September or at some other month is really not the most relevant piece. The second most relevant piece is, where will the rate settle? And there I'm very much on the camp that's going to be higher than it was in the pre-pandemic era. If you thought it was 2.5 in the pre-pandemic era, I think you have to look 3 or north for the nominal neutral going forward. And so that just gives us a lot of understanding of, we're not going back to pre-pandemic rates, but some continued ongoing normalization of policy as we finish getting through the battle of high inflation and we ensure that we're trying to balance both full employment and price stability. For my own view, I think that, there's a lot more information we could collect, and the thing I was looking at between, should we move quicker and should we move a little less quickly, has to do with, where's the labor market? today, initial claims for unemployment insurance remain low and below expectations. Inflation actually came in right on our expectation, my expectation, and it's not surprising there's some inflation in the goods sector, and it's very encouraging that there continues to be some disinflation in other sectors. So I think we've got policy in a good place today, and we'll continue to learn more about how the uncertainty on tariffs and other things prove out. And one of the big jobs we all have between now and through the rest of the year is to be out among businesses, community groups, workers, asking what's the lived experience of the economy, and not what did you do yesterday, which is largely what the published data tell us, but what are you going to do tomorrow? How are you planning? Are you building? I've been doing crane counting. That's a really fascinating thing to do. If you're like me, I look at the ports and I count cranes. And if you count cranes are still going up. They're not stopped, and they're working. You have to look at whether they're working or they're just sitting there. So I was in Boise, Idaho, just a month ago for a commencement speech, and what I saw was cranes still being constructed, going up. So there's optimism there, and there's also continuing to work and to build. So I don't want to be too optimistic, but I'm certainly not pessimistic.
Well, you mentioned that interest rates are going to settle at a higher rate than they were. I don't think
in all likelihood.
Probably nobody expects them to go back to zero again.
2.5, though, I think is where they used to be as a nominal neutral.
I know somebody who got basically a 2.5% mortgage, and she lets me know about that all the time. Where do you think it is? This is the question that the polls discussed. Where is neutral?
I think, my own personal view is I penciled in a view in my head of 3, but if you really are a student of any of the star variables other than the one that we name, which is 2% inflation, you know that there's a great deal of humility that comes with the estimate. So I think a better way to think about it is it's 3 or north of 3. I don't see a lot of evidence that it's south of 3. But again, you have to have an open mind on these things. And the place you know it is in the economy. So right now we have interest rates much higher than 3, 100 basis points higher, and we still have growth coming out solid. And this just tells me they're modestly restrictive, maybe moderately. I don't know how to really dice and slice moderately versus modestly, but a little restrictive. And if the neutral rate was something like 2.5, they would be potentially much more restrictive than we're seeing them play out in the economy.
Question about, I'm just going to slide in a little technical question here. It came up in the earlier discussion. Why does the Fed look at the personal consumption index and make that their target instead of the CPI, which is what everybody's familiar with?
So I guess it would be useful to recognize or to say out loud so everybody knows, just because we have a target variable doesn't mean we're not looking at all the other indices. And when you have price stability, these indices are all moving in the same way. And so they look really tight. They're not next to each other. They all have a little bit of difference, but that difference is historical. It's a constant. And you can figure out that they're all moving in the same way. When you don't have price stability, you're poring over every single aspect, not just the headline numbers, but all the different sectors, trying to understand what are the leading indicators for inflation spilling over? What are the lagging ones that are already behind us, so we shouldn't worry about them? And that's what we do. I mean, I have pages of what we call the dashboard of inflation indicators. And the ones that have been proven most useful are actually not those headline numbers at all. The things that are proven most useful are there's a survey that the Bureau of Labor Statistics has done, which asks what percentage of prices have gone up and what percentage of firms say they're going to raise prices in the future. And then the second part of their series is how frequently are firms changing their prices. In the heat of the 7% inflation, firms only had one direction. I'm moving prices up, and the frequency of price changes had skyrocketed relative to normal. So we have this theory in economics called menu cost, meaning you all don't want to change your prices very frequently because you have to change the menu. Well, if you go to the local businesses out in Oakland where I live, you would see that people just took the Sharpies and they just wrote through the price and then wrote a new one. It was all in these paper and pencil kind of things because the prices was changing so much. So we don't see that happening now, and that's a good sign. So the PCE, why did we pick it? People might tell you different things, but here's ultimately why. If you look at a set of statistical analysis that say what's the best predictor of underlying inflation going forward, the PCE is the most reliable predictor. And it is one where it's analytically important. So it gives us a good guidance for how to follow inflation that's not moved around by idiosyncratic factors. But I will definitely offer to you, if that was all we looked at, we wouldn't have the complete picture. So we look at everything.
A couple of questions on prices. Chaos in Washington. We all have seen that for the last couple of months, and yet the stock market keeps going up and up and up. How do you think about asset prices? How does that play into your view of inflation and what you need to do in terms of policy?
Well, it's one variable, one financial variable in an array of financial variables that we take in. All of this is inputs to my thinking about how loose or tight our monetary policy and conditions, financial conditions, not just monetary policy. And the stock market moves around for a variety of reasons. The Mag 7's very hot, and that continues to be. Other stocks are building as well. But if you step back now, I think of this as just another measure of optimism or lack thereof in the economy. And if the stock market was very much out of line with what I hear when I go and talk to businesses, then I would have more concern. But right now I hear it as a reflection of the optimism people have in the economy. I mean, I have the benefit of not living in Washington, and it gives you some distance. And so I spend more time with businesses and communities, and people aren't as, I think they don't read the news every day. They actually work on their business every day. And so when you work on your business every day, you're looking at, do I have a demand for my products? How much does it cost to get the inputs I need? What are the opportunities for expansion that I see? And I do see that there is that cautious optimism, and that's reflected in the stock market as well.